Hey, what's up everybody? Peter here once again. Welcome to my channel. This is your first time here. My name's Peter. I'm a mortgage banker and I'm also a vending machine operator. It's a very unique combo, but I love it. Anyway guys, today's topic I am going to talk about, am I ready to buy a home? Am I ready to buy a home? Okay, the only person that can answer that question is you. In other words, are you ready to pull the trigger and buy your first property? Well, you have to ask yourself this, okay? How much money am I bringing home? Not just your gross. I'm not going to talk about gross right now. I'm going to talk about what exactly do you have left right now after all your bills are paid that you could be comfortable with. Because at the end of the day, the last thing you want is to buy that dream home that you want, and next thing you know, you're struggling to make ends meet. Okay, the bank looks at qualifications a lot different than you do. Okay, because I'll give you an example. All right, a lender will look at anywhere between 45% to 50% of your income, and that's before taxes. And we all know that we have to pay taxes, right? So if a household income is $10,000, the lender will qualify you on a $4,500 to $5,000 debt load per month, okay? And so if it's $4,500, you got to remember, if you have credit card bills, a car payment, and let's say all of those equate to $1,000 a month, okay? So let's say you have a $500 car payment, then you have $200 credit card payment, then you have another $200 student loan payment, then another $100, let's say Home Depot credit card. That's $1,000 a month. So if you and your spouse, or you and your, whoever you're gonna buy the house with, or maybe you by yourself, is making $10,000 a month before taxes, then that means you are qualified to get a $3,500 house payment. Okay, so the question you need to ask yourself, because that puts you at the 45% debt ratio mark, okay, can I afford that based on what I'm making after taxes? Because if you're grossing around $10,000 after taxes and your health insurance and let's say your contribution to 401k or whatnot, you're probably bringing home around $6,500 to $7,000 a month. So if you take on a debt load of $4,500 a month, okay, and you're bringing home $7,000 a month, you're still safe. But you got to remember, that doesn't include your miscellaneous expenses like going out to eat, buying groceries, your cell phone bill, your electric bill, your cell phone bill, your gas bill, your internet bill at home, your cable bill, all that good stuff. Okay, so if you're bringing home around $7,000 and you already took on a $4,500 a month debt based on the $1,000 credit card debts and all that, plus a $3,500 house payment, you are left with $2,500. Now for most people that's okay, all right, that's actually pretty comfortable. But those are the things you got to look at in terms of how much can I afford and how much do I really want to put myself in a position of, because basically you could pretty much bank on around $800 a month for every $100,000 that you're buying. I mean, all results will be different, but it's a common ground that you could take a look at. And if you want to be extra conservative, $1,000 a month for every $100,000 you borrow. Okay, but you want to take a look at an actual cost amount, and that's when you have to talk to a mortgage professional. Okay, like a lot of people always question, well, I want to put this much down, I want to buy this much of a house. Again, go back to the drawing board. I always tell everyone, math doesn't lie, okay? Look at the house you want to buy, have the money set aside on what you want to borrow, okay? And have the money set aside on how much you want to put down in your home. Now another thing, people have asked me, Peter, can I use my 401k? Can I borrow against my 401k to put down as on my home? Yes, you can. And it will not affect your debt ratio if you use it for a home loan. But do keep in mind that your employer will remove that amount that you borrowed from your income. So now, instead of you bringing home $7,000 out of your $10,000 a month salary, okay, if you borrowed, let's say $50,000 to put down in your home, it's probably going to cost you around $500 a month. So that means you're not bringing home $7,000 anymore. You're probably going to be bringing home around $6,500. So do your homework, do your due diligence, look at all the numbers, add them all up, because at the end of the day, the ball is in your court, and only you can know how much you can truly afford. But in terms of the lenders, they would always take out 45 to 50% of your gross income. So again, the fastest way to calculate that is this: take your monthly gross income, take half of that, then subtract all of your monthly payments that are associated on your credit report. That's only credit cards, car payments, student loans, anything that's on your credit report, subtract from that monthly payment. Then that is a house payment the bank will be comfortable lending you. So on a $10,000 note, 50% of that is $5,000. Okay, out of $5,000, you subtract your debts. Okay, and then at that point, then you can use that money for your home. Anyway, guys, I just wanted to shed that light towards you guys and see if I can answer any of your guys' questions. I will post a link down below if you guys have any questions or concerns, my email, and it will be down there. You can comment down below and we'll talk some more on that. All right, have a good day, and I'll talk to you guys soon. Bye.